If you're watching mortgage rates lately and in the market, you may have noticed something a little strange. Fixed rates are, in fact, going up. And a lot of people's first instinct is to blame the Bank of Canada. But here's the thing, the Bank of Canada hasn't raised rates. So, what's actually pushing your fixed mortgage rates higher? That's exactly what we're going to break down today. I'm going to explain what's happening in the global bond market and why it matters to every single person with a mortgage or who's looking to attain a mortgage in BC. And most importantly, what you should actually do about it. Whether you're buying right now, coming up for renewal, or just trying to understand what's going on with rates, this one's for you. So let's get into it. To understand why fixed mortgage rates are moving, you first need to understand what government bonds are and what that is. Think of it this way. When a government needs to borrow money, it issues a bond. Investors buy those bonds in exchange for regular interest payments. Now, when investors start losing confidence in a government's ability to manage its debt, they demand higher interest payments before they'll lend that government money. That's exactly what's happening right now on a global scale. Let's start with the biggest story. The United States national debt just crossed $40 trillion for the first time in history. The U.S. government is now paying more than $3 billion a day just in interest on their debts. That's every single day. And investors around the world are watching that number and, well, they're getting nervous. On top of that, the conflict between the United States and Iran has pushed energy prices, higher and added serious inflation uncertainty to an already fragile global picture. The results of this, investors are selling government bonds. When bond prices fall, yields, which is the interest rate on those bonds, go up. And that brings us directly to fixed mortgage rates. Here in Canada, fixed rates are priced off the Government of Canada 5-year bond yield. When the yield goes up, lenders raise fixed mortgage rates. It's almost automatic. And right now, 5-year Government of Canada bond yields, well, they're trending near a 12-month high. Lenders have already repositioned this. Fixed rates on 3 and 5-year terms have moved up meaningfully in just the past couple of weeks. Now, here's the part that most people miss. Canadian bond yields don't move in isolation. They're heavily influenced by U.S. Treasury yields, and the U.S. yields have been climbing sharply. So even though the Bank of Canada hasn't touched its policy rate, your fixed rates that you're looking at, well, they're still going up. These are two completely separate mechanisms. The Bank of Canada controls variable interest rates. The bond market controls the fixed rates. Understanding that distinction is honestly one of the most important things any mortgage holder in Canada could know right now in this market. So given all of this, what do you actually do? Let's talk about fixed rates for a second here. Fixed rates are on the upward trajectory because of everything we just covered. But here's the thing. They haven't gone up so dramatically that variable suddenly looks like the obvious win. With a fixed rate, you get certainty. Your payment doesn't change. You know exactly what you owe for the next 3, 4, 5 years. In an environment that's uncertain, that can have real value to it. Now, let's flip that coin and talk about the variables for a second. Variable rates are tied to the Bank of Canada's policy rate, which hasn't moved yet. And there's a reasonable argument that if the trade war with the US continues to hammer the Canadian economy, the Bank of Canada could actually cut rates back, which is good news for variable rate mortgage holders. But here's the honest counterpart. If inflation keeps running hot globally, the Bank of Canada could also be forced to increase those rates. And once they start hiking, historically, they don't stop after one move. They keep going until inflation is back under wraps and in control. So the variable case right now requires you to have a genuine financial level of flexibility and understanding of your numbers. If rates went up from here, could your household absorb the higher payments, or is it going to put so much shock on you that you can't afford to pay your mortgage? And this is not a rhetorical question. It's the actual question you need to answer, and something that I ask customers when we do explore variable rate mortgages, especially in environments like this. And before you choose, you need to understand that taking a variable just because it's the lowest rate and it makes your payment more affordable is not necessarily the right choice. But before we get into that, let's bring this home to British Columbia specifically, because there are a few things here that are worth calling out. First, BC is one of the provinces most exposed to what's happening right now. The trade war with the US hits BC particularly hard because of our exposure to lumber, energy, and cross-border trade. A University of Calgary economist estimates that if the 50% tariffs hold, Canada could lose nearly 90,000 jobs. And BC is named as one of the hardest hit provinces. But what does that mean for your mortgage? Economic uncertainty slows buyer confidence. It keeps people on the sidelines, and it puts the Bank of Canada in a very difficult position because they're balancing the risk of inflation on one side and a massive economic slowdown on the other. Second, if you're coming up for renewal in BC, you are renewing into a different rate environment. The gap between where you were and where rates are today will vary depending on the original terms and timing and lender you're with. But the key point is this: you have options. And getting advice before you just auto renew with your bank could genuinely save you money. And we're not talking like $10, $15. We're talking thousands to tens of thousands of dollars. If you're buying right now, get pre-approved or pre-qualified immediately and lock in a rate hold for 90 to 120 days, whatever's available for you. And make sure it's a lender that's going to lock the whole rate sheet, not just one or two products on it, so you know that you have options if rates continue moving. In a rising rate environment, that protection is worth using and it's worth having. If you're renewing in the next 6 to 12 months, don't wait for the renewal letter to show up before you start looking at options, and definitely don't sign that first piece of paperwork the bank sends you. There's commonly better rate options available. And one of the things we focus on with this is not only making sure that you're with a lender that's got the best rates and products, but that has the best terms and conditions with your mortgage as well. For example, if you're with a chartered bank like Scotiabank, RBC, Bank of Montreal, CIBC, it may make sense to move to one of the monoline lenders to secure a mortgage that has lower penalty structures. So that way, if things continue changing and becoming better, you're going to have a much easier time accessing lower rates at lower penalties and costs. Another thing to consider with this, you can generally lock in a rate for 90 to 120 days. So if they're giving you your renewal letter a week before your renewal, 2 weeks before your renewal, it's not really benefiting you or helping you. So get in touch with someone early so that once you hit that 120-day mark, you can lock a rate in. If rates go up, you're protected. If they go down, you just get the lower interest rate. Now, if you're currently in a variable rate, revisit your risk tolerance, honestly. If the thought of rates going higher from here would genuinely hurt your household budget, it's worth having that conversation about whether converting to a fixed rate makes sense. That's not a decision to make based off headlines. It's a decision to make based on your actual numbers and your actual risk tolerance and comfort levels. And if you're sitting on the sidelines waiting, understand that waiting for rates to come back down to where they were, let's say 2, 3, 4, or even 5 years ago, it's not a strategy most experts are going to recommend to you right now. And the reason for that is those COVID rates at 2% or less, those are gone. They're probably not coming back. And sitting there trying to time the market perfectly is like finding a needle in a haystack. I know that's an old phrase and it's a bit lame, but it's the only one I can think of for describing this because it is that difficult. You're never going to have the perfect timing. You need to make sure and sit down, is now the right time to purchase a house or make a change, or should I be waiting? And the only way to do that is understanding your exact numbers in this exact market. So I know that's a lot to take in. Bond markets, treasury yields, tariffs, stress tests, fixed first variable. It can feel very overwhelming, and I totally understand that. But here's the simple version. Rates are moving because of forces that are bigger than just Canada. The Bank of Canada didn't do this. Global debt and global conflict did. What you can control is what you do with that information. If any of what I covered today applies to your situation, whether you're buying, renting, or just trying to figure out if you're in the right mortgage right now, you can book a call with me using the link in my description and in my profile so that we can chat about options and make sure things are working for you. There's no pressure here. It's not a sales pitch. It's literally just clarity and trying to have a conversation. My name is Myles Nowik, owner of the Nowik Mortgage Team, powered by Indy Mortgage. We've been working in Nanaimo, British Columbia for, 36 years, and we've done well over $2 billion in mortgages. And if you want help from us, we're more than happy to do that. And if you got value out of this video, maybe hit that like and subscribe button so more people like you can see it. Thanks so much. We'll catch you on the next one.